Good morning, everybody. I hope you all had a good weekend. And for some of you that may have had an extended break over the Christmas period, welcome back and all the best for 2016 and the year ahead. Straight to the markets. I'm sure you've all been listening to the news and looking at the various news stories. We've had a shocker of a week. Dow was down 6.2%. The Nasdaq was down 7.3%. The FTSE was down 5.1%. The DAX down 8.3%, the Nikkei down 7%, and of course what led this domino effect was China, which was down 10% on the week. A lot of uncertainty still over there, and just bear in mind that China is still very much in its infancy when it comes to a stock market, and it is purely a market condition that's creating these falls in value, rather than the fundamentals of the companies which exist. But we've seen some losses. Again, I always talk about my bundle of four. They're down, although as normal, not down quite as bad as the Nasdaq was. We've got Google down 5.9%, Facebook down 7%, Apple 7.9%, Microsoft 5.7%. Had you been invested in all four of those, your losses would have only been 6.6% in comparison with 7.3% had you gone with the Nasdaq as a whole. So once again, the theory follows good. In the currencies, we've got a strong US dollar. We've got it at 1.09 against the euro, which was pretty much flat on the week. 1.45 against sterling, which is as low as I can remember it being for quite a while. I think the stats are about 7 years ago, I think was the last time, 6-7 years ago, we saw sterling as weak as that. It fell by 1.7%. The Japanese yen actually picked up against the US dollar during the week. It was up 3.8%. And the Chinese yuan, as we know, is falling, although that is what the Chinese government wants, is a weaker yuan against the US dollar, as it wants to encourage exporting. Another reason why we've seen some falls. And yes, I know it's scary when you wake up in the morning and you see your portfolio has fallen 5-10%, but believe in the fundamentals of the company. Believe in, people are not going to stop brushing their teeth if you own Colgate shares because the markets are down. People are not going to stop washing with Dove shampoo because the markets are down. There's still a lot of people that are coming out of poverty and have more expendable income in their pockets. So life goes on. A good example of this is Apple. Apple was down 7.9%, so worse than the Nasdaq, 7.3%. There's differing views on Apple. Some guys out there, some analysts are saying it could be $200 a share. Some would say it's pretty much a spent force when it got to such a size that it was always going to end up struggling a little bit. I'm very bullish on Apple still. I believe it falls into the category that you have a developing, you have a lot of people coming out of poverty and buying an iPhone or other Apple products are something which way that they'll be able to do once they have enough income to do so. So to look at the rest of it, as again you say, technology, as you know, very bullish on. Still, those four shares, I would still buy it all day long. I am actually considering looking at mining. I think Glencore and Anglo American may be a good time to go in, and I'll be on the lookout for a decent fund manager in the mining sector, as I think there could be some value bought there. On the sporting fields this weekend, it was all pretty quiet in the sports that I tend to follow. We had the FA Cup this weekend. No major shocks. A couple of teams didn't quite manage to get the job done, such as Liverpool. The FA Cup these days, sadly, from a British point of view, seems to play second fiddle often with the foreign managers. So you're not always getting what you're used to. And I don't think a lot of the sort of mid-team Premiership sides almost see it more as a hindrance, and which is a shame because I'd imagine that a lot of players would still dream about winning the FA Cup as kids. So a little bit of scary facts again. I always like to talk about, pension funds. As you know, we can help here at OIB with people's pensions and defined benefits. Pension funds for some of the larger companies are in real deficit. As you can guess, the oil companies rather are some of the worst. I mean, at the end of 2014, BP and Royal Dutch Shell were two of the five largest pension deficits on the UK market. We had Royal Dutch Shell with a deficit of 6.7 billion and BP with a deficit of 5.5 billion. A lot of my clients are in the oil and gas industry, and if you've moved overseas and you have one of those pensions, get your money out, because at the end of the day, it's not going to get any better. And I wonder what those figures will look like once the 2015 accounts have been published. You can bet one thing for sure, and that's that they're not going to look any better. So for the quote for the day, we'll go back to probably the most quoted man in this, because he is the greatest investor of all time, and that's Warren Buffett. And you've probably all heard this quote before, but one of Warren's favourite saying is, you should be fearful when everyone else is being greedy, and greedy when everyone else is fearful. Everybody seems fearful out there. Everybody's talking about another 2008. So now's the time to be greedy. This is a problem. It's not great. We've seen the markets do this, but at the same time, it's been all because of the timing. If this had happened on the third week in August, no one would have been, quite so hit up about the whole situation. Because it's happened at the beginning of the year, it accentuates things and it worries. Get involved. There's good companies out there at good value today. Have a nice week.